Every major financial crash over the last 100 years has followed one exact roadmap. Not a similar path, not something close, the same sequence every time. It happened in 1929, it happened in 1987, it happened in 2000, it happened again in 2008. This sequence has 5 distinct stages, and they begin showing up months, sometimes even years before the actual collapse hits. Wall Street understands this pattern. The Federal Reserve understands it. The people who manage money for billionaires absolutely understand it. But most regular people have never been told about it. And there's a reason for that. If everyday investors knew what warning signs to watch for, they would pull their money before a crash hit, not after it. That would break the system. Today, I'm going to explain all 5 stages. And more importantly, I'm going to show you exactly where we are right now in that sequence. Spoiler alert, we're much further along than most people realize. Back in 1929, a man named Roger Babson gave a speech at a business conference. During that speech, he said 9 words that instantly made him one of the most hated men on Wall Street. Sooner or later, a crash is coming, and it may be terrific. People laughed at him. Newspapers ridiculed him. Irving Fisher, the most respected economist of that era, publicly dismissed Babson and confidently stated that stocks had reached a permanently high plateau. Just 47 days later, the market collapsed. Fisher lost everything he had. His wealth disappeared, his reputation was destroyed. He died in poverty. Babson, on the other hand, made a fortune and later founded a college that still exists today. Here's the part most people don't know. Babson wasn't making a wild guess. He had created a structured way to analyze financial systems. He focused on 5 specific factors: credit expansion, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 factors, 5 stages. I spent 3 months digging through historical records, Federal Reserve data, and academic research to test whether his framework actually worked across different crashes. It does, every single time. Let's walk through it together. Stage 1, the credit explosion. This is always where it starts. Not greed, not speculation, debt. Before every major crash, credit grows faster than the real economy can handle. People take on loans they cannot realistically repay. They use that borrowed money to buy assets. Asset prices rise. Rising prices make people feel richer. Feeling richer encourages even more borrowing. It creates a loop that looks like prosperity, but is actually a trap. In the late 1920s, margin debt surged. Regular Americans were putting down 10% and borrowing 90% to buy stocks. By 1929, total margin debt was equal to the entire federal budget. Factory workers were leveraged like hedge funds. In 2007, the problem was mortgage debt. Banks created complex products that allowed people to buy homes with no money down. Those mortgages were bundled into securities and sold to pension funds. The risk was hidden, but it was everywhere. In 2000, it was corporate debt. Companies with no profits borrowed billions to expand. Their stock was used as collateral. When stock prices dropped, the whole structure collapsed. Now, look at today. Official margin debt is around $750 billion, but that number is misleading. It only captures a small portion of the leverage in the system. Add securities-based lending, where wealthy investors borrow against their portfolios, and you add another $800 billion. Add 8 more in exposure. Add corporate debt, now over $10 trillion, much of it used for stock buybacks instead of real growth. Add government debt, which has crossed $34 trillion, with interest payments larger than the defense budget. As a share of GDP, total debt in the U.S. economy is now higher than it was in 1929, higher than 2008, and higher than at any other time in recorded history. Stage 1 isn't just flashing red, it's burning. Stage 2, the concentration trap. This is something most finance classes never explain. Markets don't crash just because prices are high. They crash because risk becomes concentrated. When a small group of assets holds too much of the market's value, the entire system becomes fragile. If one of those assets stumbles, it pulls everything down with it. In 1929, a few glamour stocks dominated the market. The biggest was Radio Corporation of America. Its stock rose from under $2 to over $500 in just a few years. People didn't understand radio technology. They just knew the price kept rising. When RCA cracked, the whole market followed. In 2000, it was the dot-com giants. Cisco, Intel, Microsoft, and a few others dominated the Nasdaq. The entire market was basically a bet on about 10 companies. When those stocks fell, trillions in wealth disappeared. In 2008, the concentration was hidden inside the banking system. 5 banks held most of the derivatives exposure. When Lehman Brothers collapsed, the entire system nearly went with it. Now look at today. The top 7 stocks in the S&P 500 make up more than 30% of the entire index. At some points this year, that number was closer to 35%. That means when you buy an S&P 500 index fund, which sits inside most 401k and retirement accounts, you're not really buying 500 companies. You're making a massive bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And those 7 stocks are priced for perfection, not good performance, perfect performance. Any slowdown, any missed expectation, and selling feeds on itself. Passive investing makes this worse. Money flowing into index funds automatically buys more of the biggest stocks. That pushes their prices higher, increases their weight, and forces the next dollar to buy even more of them. It works beautifully on the way up. On the way down, it reverses violently. This is stage 2, and we are deeper in it than ever before. Stage 3, the smart money exit. This stage is the most frustrating because it shows how the system really works. Before every crash, large institutions quietly reduce risk. Banks, hedge funds, family offices, and billionaires sell assets, raise cash, and buy protection. They don't announce it. They don't warn anyone. Publicly, they tell everyone to stay calm. In 1929, the Morgan and Rockefeller interests began selling months before the crash. Bernard Baruch was mostly in cash by September. Joseph Kennedy sold everything early, not because of a shoeshine boy, but because he had insider connections. Regular Americans kept buying. They were the exit liquidity. In 2007, hedge funds began shorting subprime mortgages a full year before the collapse. Goldman Sachs bet against products it was selling to clients. Mortgage executives dumped personal stock while telling investors everything was fine. Regular people kept buying. They were the exit liquidity. Today, insider selling is at levels not seen in decades. CEOs, CFOs, and board members are selling at historic rates. Insider selling vastly outweighs insider buying. At the same time, retail investors are pouring money in. Robinhood accounts, 401k contributions, and passive index flows are hitting records. Smart money is selling. Regular people are buying. This is not random. This is the pattern. Stage 3 is flashing red.
Stage 4. The liquidity illusion. This is the most deceptive stage. Everything still looks normal. Prices hold up. Trading continues. Nothing seems broken. But liquidity, the lifeblood of markets, is quietly draining away. When liquidity is strong, markets absorb shocks. Prices move smoothly. When liquidity disappears, prices gap violently. Small selling causes massive drops. In 1928 and 1929, the Federal Reserve raised rates to cool speculation. Liquidity slowly dried up. The market kept rising, so people assumed it didn't matter. When selling started, buyers vanished. Prices collapsed. In 2007 and 2008, the same thing happened. Rates rose, credit tightened, everything looked fine until Bear Stearns fell, then Lehman. The market dropped 50% in months. Today, the Federal Reserve has raised rates at the fastest pace in 40 years, from near zero to over 5% in under 2 years. Quantitative tightening has removed hundreds of billions from the system, yet stocks sit near all-time highs. People think this means the tightening doesn't matter. They believe in a soft landing.
they're wrong. In March 2023, 3 major banks failed in a single week: Silicon Valley Bank, Signature Bank, and First Republic. Emergency programs were launched to stop contagion. These programs are temporary. They delay problems. They don't fix them. Even the Treasury market, the backbone of global finance, has shown signs of stress. This is stage 4, calm on the surface, oxygen disappearing underneath. Stage 5, the trigger. This is the only stage nobody can predict. The trigger doesn't cause the crash, it simply starts it. In 1929, the trigger was the Haytree case. A British financier, Clarence Haytree, was arrested for fraud. British banks sold U.S. assets to raise cash. Selling snowballed. The Great Depression followed. In 2008, the trigger was Lehman Brothers, but it could have been any major institution. So what will it be this time? No one knows. It could be geopolitical. It could be financial. It could be banking related. It could involve derivatives, which total over $600 trillion in notional value. History shows that when stages 1 through 4 are active, the trigger usually arrives within 12 to 24 months. All 4 stages have been present since late 2024. That places the window in 2025 or 2026. This does not mean a crash happens tomorrow. Timing is impossible. Anyone claiming exact dates is lying. And it does not mean panic or hiding in a bunker. It means the same conditions that existed before every major crash in the last 100 years exist right now. Roger Babson prepared. Irving Fisher ignored the signals. The difference wasn't intelligence, it was awareness. You now have the same choice. If this helped you see something new, subscribe and turn on notifications. I'll be breaking down each stage with real data you can track yourself. Knowledge alone isn't power. Applied knowledge is. The signals were there in 1929. They were there in 2008. They are here now. Don't choose to ignore them.